Hello everyone. In continuation of the previous lecture, part 1 of financial concept, I will continue the part 2 as well related with the financial concept. Some other financial concepts I have taken for this lecture. First concept is dividend. Dividend is what? Dividend is a kind of it is the result of the operational activity which is done by the company in a duration of a particular period. In particular duration, whatever the profit earned by the company, that profit is distributed among the shareholders, among the owners of the company. That is known as dividend. Dividend word is arrived from the word divide. It means what we have to divide? We have to divide the profit among the shareholders, among the owners of the company. So that is known as the dividend, and it can be given by the company in form of cash, in form of asset, in form of the like check, or it depends whatever the strategy or policy company has made regarding the dividend. So that is distributed among the shareholders by the company. So it is what? It is a part of profit actually which is distributed, which is shared among the shareholders, among the owners of the company. Ratio is what? It's a very interesting topic. It is generally used by the company to analyze the financial performance of the company, and it is one of the tool for financial statement analysis. Ratio is the relationship between the two variables. It can be these variables can be anything. Can be sales and profit, can be fixed assets and fixed current assets, depends whatever the situation, whatever the criteria company has to evaluate. And ratio is generally a term which is used in maths, which is used in other subjects also. But ratio, here we have to identify the relationship between the variables, and nothing is constant in business. In long term, in short term, fixed current assets also changes continuously, you know that, current assets and current liability. But fixed assets also change, fixed assets will also change in long term, fixed liability as well. So if the ratio can be calculated for anything which is not constant in business. So it is the relationship between the two variables. It is an effective tool used by the company, used by the shareholders, creditors, stakeholders, investors, to measure the financial performance of the company, to measure the profitability of the company, to measure the strength of the company, to know what the company is doing currently, if the company is performing good or not. So it is one of the criteria, it is one of the method to evaluate the financial performance of the company. Financial planning. Financial planning is the process of taking comprehensive look at your financial situation, or building a specific financial plan to reach your goals. It can be the financial plan can be made by the company, and if I'll talk about the financial planning, it is done for the company also, can be done for the person also. So depends which kind of resources you have and for what you are just planning. If you are running a company, so you have to make the financial plan as per the requirement of that. You need to plan about investing, you need to plan about the taxes, savings, everything, expense, cost, everything. When you will include your personal planning, you have to just look out the investment plans, taxes, savings, retirement plans, insurance, and any other expense which you have to done in future. Actually, this financial planning is done as per the resources available for you, and you have to make the future plans with the help of this, so you can achieve your goals and targets in a specific manner, and you can reach your goals and targets easily with this plan. Return on investment, it is a very important term in finance. Return on investment, when I'll talk about the investment, before investing in any of the business, company has to see either this investment will give the return or not. If it is profitable, so then the company has to invest. If it is not profitable, company should not invest in that. So it is the basically it is a calculation used to determine whether or not an investment is profitable or not profitable. If the company has to calculate the ROI, company should need to see the profit or return generated by that, and the investment amount which the company has to invest in a particular business. It is done for the future, and it is one of the criteria of capital budgeting decision when the company has to decide either this investment is profitable or not. So this kind of decision basically taken by the company in investment. Whenever the company has to invest in any project, any business, company has to buy any asset, company has to invest in a short term investment, shares, debentures, bonds, whatever is that, company has to invest in any securities, company has to invest in project, product, assets, company need to see the return on investment on that. Ways of ROI can be expressed. It can be expressed in ratio, it can be expressed in percentage, it can be expressed in multiples. Investment decision, again it is related with the ROI. When the company has to decide, either the company has to invest or not, because whenever a person has to start a business, he has a lot of options. He has to see that there are n number of alternatives. Suppose he has 4 alternatives, he cannot invest in all of the businesses, he has to invest in only one business. At that very moment he has to decide, he has to make the choice of one business. So that is known as the investment decision. An investment decision, whenever the company has to take investment decision, it is having a long term perspective. Long term funds are used as a period for fixed and also for the current assets, and this kind of investment is this kind of decision is taken by the company to buy an asset, or to make the investment for manufacturing a particular product, or to invest in a particular business or in a particular area of venture. So whenever the company has to decide, the company has to invest in a particular business or not, that is known as investment decision. And this decision is taken by basically by the capital budgeting. There are some techniques in capital budgeting in which you can evaluate this business is profitable for you, which alternative is profitable for you. So these techniques we will discuss in later on some other lectures, but right now we can understand, I can just explain you the concept of investment decision. It is what? It is the type of a decision which is taken by the company for investment in a particular business, for a particular asset, or in a particular product. Now budgeting. Budgeting is the process of creating a plan to spend for your money. Means it's a forecasting. It's a forecasting of future expense. Whatever the expense, whatever the plan you have to make the plan related with the expense, whatever you have to incur in future. So budgeting is the process in which you have to decide the future expense, and this is the process which helps in determining the expense and evaluating and comparing the actual expense with the incurred expense. So you can just compare the budgeted expense with the actual expense, and you can identify your budget is perfect or there is any loophole in that. If the expense are more than the budgeted amount, so you can evaluate what are the reasons for that. If the budgeted amount is if the actual expense is less than the budgeted amount, so that is good for the company, means company has planned in a proper manner, company has worked out in a proper manner. So this is one of the criteria to make your expense, to list the expense, to measure your expense, to identify the future amount or future expense you have to incur in a particular project or product, in which you have to see, you have to compare income with the actual expense also. Now thank you so much. In other PPT, in other lectures we will discuss some other concepts related with the finance. So thank you so much.